I listened to the brokerage firm's calls and the CDC's news conference on the current market, and they expect this quarantine to last a long time. The colleges are canceling graduations, sports seasons are being canceled, and it seems like the world as we know it is coming to an end. Why should we believe that the markets will snap back quickly? Many analysts are saying it will take at least 10 years to get back to the February highs.
That's where it's really important to have a long-term vision. If you see the economy evolving and developing along a trajectory that's driven by demography, technology, and human behavior, it's easy to see where things are going. However, it's also easy to look in the rearview mirror and assume that the world is always going to be like it has been in the past. Somebody that's always criticized is Thomas Malthus. People don't realize that Malthus made perfect sense in the early part of the 19th century. If you look back at history that he would have had available, we see that the world economy had basically been stagnant. Every time the population increased, basically you had starvation and the economy imploded. However, what Malthus didn't realize was at the moment he was writing, the world had changed. The world had entered the Industrial Revolution, and suddenly the productivity of agriculture skyrocketed. And so therefore, the truth that he looked at and he assumed that had been true for thousands of years was no longer true. The same thing has happened many times in more recent periods. Consider Montgomery Ward and Sears right after World War II. The leadership at Montgomery Ward assumed that we were going to go back into the recession and depression of the 1930s, and that the world would continue in a malaise for decades. Management at Sears looked at the extraordinary demography and the extraordinary capital that had been built up during the war. And they said, no, there's going to be an explosion of consumer demand. And suddenly, Sears became by far America's dominant retailer in the 1950s and 60s, while Montgomery Ward, which had been basically the same size in 1948, became an afterthought. Now, that's the situation we face today. People look at companies and assume that the new normal, which was talked about in the Obama years, is still in place, that we're going to still have growth of 2.3%. And that's because of demography, because of aging population, because of other factors in the economy. If we look at the assumptions underlying the so-called new normal that were in place, basically from the financial crisis through the Obama years, everybody assumed that 2.6%, 2.3% economic growth was as good as we could do. But then suddenly we have things like fracking, driven by information technology, that enabled us to suddenly go from being energy dependent to being energy dominant. And as you can see today, energy prices have collapsed. And that's great for all consumers across the world. And that's just one little piece of it. Today, artificial intelligence is preparing us to do things that have never been done before, to dramatically improve productivity. Accenture, working with Frontier Economics, has forecast that average productivity growth will go from 2.3% to 4.6% by 2035. That will have a tremendous impact, and it will have a disproportionate impact on companies that are tuned into delivering that productivity growth. And that's why we're not going to be stuck in this situation for 10 years or even really 2 years. We've just had a very quick reaction, but caused by government policy. But that government policy, which is protecting us all, is only possible because of the technology. The fact that we're creating vaccines, brand new treatments, and we're able to take people and quarantine them in an effective way because of information technology is all a plus. And that's why we'll see things dramatically bounce back. We really only have one precedent for the kind of pandemic-driven economic crisis in modern times, and that is the 1958 Hong Kong flu, where we had one serious down quarter followed by a 0.4% annualized growth in the next quarter, and then 2 sequential quarters of 10% growth. That's the kind of thing that I'm expecting to see. Perhaps the second quarter will be down. The third quarter, you could see 10%. And you might even see 10% in the last quarter. It's hard to say right now, but clearly the Treasury Department is already expecting a major upturn as soon as the fourth quarter. So we'll have to see how things play out, but certainly we're not stuck in a crisis that's a generational disaster. In fact, we'll look back on this as just a blip.
Just a blip. Very encouraging words to hear in such uncertain times. Now, Carolyn, I think you have one last question for us today.
So, Fred, at this point in time, China has kind of cornered the market on the kinds of minerals that the technology industry requires, and oil is just so in oversupply from being peak oil a couple of years ago. Now it's in oversupply. How do you see the world getting through these shortages and surpluses?
The world has just gone through a dramatic transition that we call the dematerialization frontier. The idea is that in the past, every time, in fact, through 1970, every time you had an increase in GDP, you had a pretty consistent increase in material consumption. If you look at metals, water, energy, agricultural products, and inputs, it was always consistently higher with each incremental unit of GDP. Today, increases in GDP no longer require increases in material input. If you look at the OECD countries, particularly the United States, Britain, and most of Western Europe and Japan, you see that GDP is continuing to rise at a very dramatic rate, but yet the consumption of materials is shrinking. And that is after you consider the inputs that are coming from overseas. So not only are those countries doing less production of goods, but they're also bringing in less goods produced in other places. Therefore, as we move toward a true 21st century economy, once again, the outplaying of this digital revolution that we're in, we're getting to the point where those constraints don't matter anymore. The kind of constraints that 19th century and even 20th century industry was based on don't hold true. It's the point that the challenge is to get the rest of the world to the level of affluence that the United States and Britain are at today. Once that's achieved, there's no stopping the global economy and the rise in the standard of livings of mankind. And we can all profit from that. In fact, that's the big message here, that this panic is just another one of those little bumps in the road on the way up.